Hi everybody, this is a short course on stock valuation. This is number 7 homework section. Okay, here's solution. Okay, we're gonna calculate risk premium on earnings for a certain stock. Only we need is two things, which is sales and net income. So, for example, we have sales samples, which are 12 in number, and net income numbers. Also, we have 12 samples. This is it. And what risk premium? It would be standard deviation of growth rate on net income, which is risk premium on earnings. So let's try to first get the growth rate on net income. And here, these are growth rate on net income on a continuous compound basis, which is first growth rate would be ln logarithm ln this over this, new net income over old net income. And second growth rate is here, ln this over this, and so on and so on. Because we have 12 net income samples, we have 11 net income growth year-on-year basis. However, if you look at carefully in net income here, for the year December 16, we have negative net income, which is net loss. If we have net loss, what happened? We cannot calculate growth rate because ln function do not allow negative numbers. ln function only allow positive number. So growth rate here and here, from plus net income to minus net income, and from minus net income to plus positive net income, we cannot calculate. We have nothing, no growth rate here, no calculations. Then we cannot get standard deviation of this time sequence. If we try, first let me try to calculate this STODEV.S, standard deviation on sample basis from this time sequence. Okay. However, STODEV.S C10 to M10, we have nothing. So we cannot calculate risk premium from directory net income time series. So what happened? There's this one solution I can offer to you. Instead, directly calculating from net income sequence, we have two sequences, time series. One is sales and one is cost. Cost, the definition of cost is sales minus net income. So first year, sales minus net income would be cost. And here we have 12 cost. So you notice sales always they are positive. They never be negative numbers. And the same thing for cost. Cost always positive numbers. No negative numbers here. So growth rate of sales and the growth rates of costs we can calculate without any problem. So we can calculate them all without any problem, which is great. Then what to do is next, what we do is to assume a cost structure of this company. Cost structure, what is cost structure? It's sales over cost and how much would be the margin, net income margin. We can calculate by LN, newest sales over newest cost, which is here. LN M3 over M5. Sales over the cost. And then this company recently have almost 18% margin, which is great. And margin, we define it as a B. B would be 18%. And if a margin of a company is 18%, but if the margin next year improves by 1.8%, it should be 10. So impact on margin improvement, we can thus calculate by A. A equals 1 over B. So 1 over 18% would be 5.57, right? This one. And 1 minus A would be negative 4.57, which is necessary to calculate on mixed time series, which is this one. Okay, we need to calculate variance, sample variance bar S of A times ds over S minus dc over C plus dc over C. Which does it mean? A times ds over S minus dc over C. First term of this. Of course, it will be impact of margin. So margin improvement impact on net income growth. And second term, DC over C is a volume impact. If cost structure would be the same, this DC over C directly equals to growth rate of net income. So A times this of the bar, we can calculate. So there's two ways of calculation of the bar variance. First calculation is we have ds over S, sales growth rate, samples, and cost growth rate, change of rate, samples, 11 samples each. Then we can easily calculate the variance on each. This one is sample variance of sales growth. And this one is sample growth rate of, sample variance of growth rate of costs. And the covariance.s. Covariance.s is a sample covariance between sales growth and the cost growth. The function is covariance.s, which is fairly easy to calculate. It's an Excel sheet function. And then variance of complex mixed, these two terms would be this calculation: a to the second power times variance of sales growth plus a minus 1 minus a to the second power times variance of cost growth rate times 2 times a times 1 minus a times covariance between sales growth rate and the cost growth rate. And the result would be this. Okay. So a times variance S and 1 minus a times 1 minus a times variance C times 2 plus 2 times covariance times a times 1 minus a, which is 0.6. The result would be 0.6. And standard deviation would be square root of variance, right? So square root of variance, so STODEV.S, sample standard deviation. Sample standard deviation is nearly 80%, which is very high. And finally, we can reach to calculate a risk premium on earnings, which is 1/3 of STODEV.S, right? So if I divided this by 3, we get almost 26% of risk premium, which is very high. For your information, these samples we get is a Japanese listed company called Tokai Carbon, which code numbers 5301, which is traded at low PE of 4.5 PE multiple. You might think 4.5 PE multiple, which is very low, it should be attractive. Not at all. This company fairly valuated at 4.5. 4.5 PE is not cheap at all. It's fair value because of this high risk premium of 26%. And second way to get risk premium on earnings is directly make A times ds over s minus dc over c plus dc over c. And this time series is calculated here. A times ds over s minus A times dc over c plus dc over c. And so on and so on. We have 11 samples of growth rate. Let me call it a y. Let me call it y. And STODEV.SY is the same result. Of course, it's the same result. STODEV.S of this time series would be 77%. And of course, risk premium is 1/3 of this. Okay, 26% again, the same, right? Okay, here's homework for stock valuation number 7, risk premium part 2. This is Jun Yamamoto. And even if you have a low PE multiple stocks, it's not necessarily cheap or attractive. Mostly, it's fairly valued. That's due to the risk premium, high risk premium, and risks the company own. Okay, thank you very much. See you soon. Bye.